Okay, let's dive into a retirement rule that trips up a lot of people. The money the government requires you to withdraw from your savings each year. It sounds simple, but trust me, the rules can get complicated, and the penalties for getting it wrong are no joke. And when I say no joke, I really mean it. A 25% penalty. That's what the IRS can hit you with if you don't follow the rules for your tax-deferred retirement accounts. That's a quarter of the money you were supposed to take out. Ouch. So, what's the deal with this rule? And more importantly, how do you stay on the right side of it? Well, that's what we're going to break down in this explainer. Everything you need to know about required minimum distributions, or RMDs. We'll cover what they are, who's affected, and how to handle them correctly, and maybe even strategically. All right, first things first. What in the world is a required minimum distribution? The best way to think about it is this. You've spent decades saving in accounts like a 401k or a traditional IRA, and all that growth has been tax-deferred. Well, the RMD is basically the government saying, all right, time's up. It's time for you to start taking some of that money out so we can finally collect the taxes on it. And here's where things start to get a little tricky. The starting age has been a moving target lately. For years, it was that famously confusing age, 70 and a half. Then, in 2020, the Secure Act bumped it to 72. And just when people got used to that, the Secure 2.0 Act came along in 2023 and pushed it again to 73. So yeah, it's no wonder people are confused. So these rules apply to pretty much all the usual suspects when it comes to tax-deferred retirement accounts. But, and this is a huge but, check out that note at the bottom. Roth IRAs. If you are the original owner of a Roth IRA, you are never required to take a distribution in your lifetime. That is a massive advantage of the Roth system. Okay, so we know what they are. Now let's get into the nitty-gritty of who needs to take them and by when. Because with RMDs, timing is absolutely everything. For the big wave of people heading into retirement right now, the magic number to remember is 73. It's pretty simple. If your 73rd birthday falls anytime this year, then congratulations, this is your very first RMD year. Now, for your very first RMD, the IRS does cut you a little slack. You have a choice. You can take it by the standard deadline, December 31st of the year you turn 73, or you can delay it just a bit until April 1st of the following year. But be really, really careful with that delay. If you wait, you'll have to take 2 RMDs in that second year, your delayed first one and your second one, and that could easily push you into a higher tax bracket. So how do you figure out the actual dollar amount you need to withdraw? Well, the formula itself is actually pretty straightforward. It's basically a simple division problem. You take your total account balance from the end of last year, that's December 31st, and you divide it by a number called a life expectancy factor, which you get from a special IRS table. And here's a little peek at what that table looks like. See how the factor or distribution period gets smaller as you get older? So for example, if you're 75, your factor is 24.6. If your account balance was, say, $1 million at the end of last year, you divide that by 24.6 and boom, that's your RMD for this year. The whole system is designed to spread the withdrawals out over your expected lifetime. Okay, now this is a nuance that trips up so many people. For your IRAs, you have to calculate the RMD for each account separately, but then you can add all those amounts together and take the grand total from just one single IRA if you want. It's flexible. But, and here's the catch, for your workplace plans like 401ks or the Federal Thrift Savings Plan, you can't do that. You have to take the specific RMD amount from each separate plan, no mixing and matching. With all these different rules, it's easy to see how a mistake can happen. So what should you do if you realize you've missed a deadline? The first thing is, don't panic. There's a process to fix it. As we saw, the standard penalty is a painful 25% of whatever you failed to withdraw. However, the Secure 2.0 Act did create a bit of a safety net. If you correct the mistake in a timely manner, which is generally within 2 years, that penalty gets reduced to 10%. Better, for sure, but still something you want to avoid. The good news is the IRS has a clear 3-step process to get this fixed. First, take the money out immediately, as soon as you realize the error. Second, you have to file a specific tax form, Form 5329, for the year you missed. And third, you attach a short letter explaining what happened and confirming that you've now fixed it. This is basically your request for forgiveness. And that letter is so important. Why? Because the IRS says it right on their website. The penalty can be waived for a reasonable error. They recognize these rules are complex. If you can show it was an honest mistake and you acted quickly to make it right, they are often willing to waive that penalty completely. But RMDs aren't just an obligation you have to meet. Let's look at how savvy retirees can actually use them as part of a larger financial and tax strategy. One of the most powerful strategies out there is the Qualified Charitable Distribution, or QCD. This lets you donate money directly from your IRA to a charity you support. And get this, you can start doing this at age 70 and a half, even before your RMDs officially kick in. And we're not talking about small amounts here. The maximum you can give this way each year is now indexed for inflation. It's over $100,000 per person. And that full amount can be used to satisfy your RMD requirement for the year. And this chart really shows the tax magic behind the QCD. If you just take your RMD as cash, it counts as income first, and then you donate. But with a QCD, the money goes straight to the charity. It's never included in your taxable income at all. For a lot of people, this can result in a significantly lower tax bill. So let's just recap the big takeaways. RMDs are a fundamental part of retirement, now starting at age 73. Missing them is costly, but it is fixable. And finally, with a little bit of planning, you can manage these withdrawals in a way that actually aligns with your bigger financial and even your charitable goals. And really, this is what you should take away from our explainer today. Don't just look at RMDs as a chore you have to deal with. Thinking about these distributions ahead of time can make a really significant difference in your retirement finances and your tax situation for years to come. And of course, these rules can be complex and everyone's situation is different. So you should always consult with a qualified financial advisor or a tax professional to get guidance that's tailored for you. This is not financial advice.